Hello everyone, welcome back to the channel. I am learning options trading these past few weeks, and one of the strategies that seems to suit me is selling cash secured put options. We will add cash secured put selling in our portfolio for additional passive income from our available cash that we are not yet prepared to be tied up on our covered call ETF portfolio for a very long time. But before anything else, what I am about to show you is for entertainment purposes only and not investment advice. Trading in options involves considerable risk and is not a suitable form of investment for all investors. The term cash secured put refers to the strategy of selling a put contract with the intent to purchase the security when it trades at a price that is lower than its current market price. A cash secured put involves both writing the option and depositing cash in a sweep account to purchase the underlying security. If an investor would like to purchase shares of a security at a price lower than its current market value, one of their options is to sell a cash secured put. An investor will do this if they believe a security will eventually increase in price, but would like to purchase the security at a price point that is lower than its currently trading price. This strategy is known as a cash secured put because in addition to selling the put, the investor also deposits into his account enough cash to purchase the underlying shares of security. When writing the put, the investor receives a premium in exchange for the obligation to purchase the stock at the contract's strike price if assigned. With a cash secured put, the investor believes the price of the security will decline in the near term and increase in value over time. Of course, there are two possible outcomes. Assignment. The price of the security declines below the strike price of the put, and the investor purchases the securities at a strike price using the cash in their account. The investor also receives a premium for writing the put, which effectively lowers their net cost or break-even point of the securities. No assignment. The price of the security remains above the strike price of the put, and the investor does not purchase the securities. When this occurs, the investor effectively loses the opportunity cost of owning the stock. However, they keep the premium paid for selling the put. As an example, we will show you how we sold the cash secured put on an ETF called SOXL and how to determine the strike price. We prefer to choose an ETF for selling cash secured put options because it is already a collection of stocks. Thus, it is not overly influenced by bad news or bad earnings that could happen on a stock. SOXL is an ETF fund that seeks daily investment results before fees and expenses of 300% of the daily performance of the ICE Semiconductor Index. The index is a rules-based, modified float-adjusted market capitalization weighted index that tracks the performance of the 30 largest US-listed semiconductor companies. The index top holdings are NVDY, Broadcom, AMD, Intel, and others. We executed this trade last July 24, and in finding the strike price, we usually use Yahoo Finance app, and wherein you can search SOXL. We have to look at the charts. Usually 1 year, and the time frame is 1 day. And we choose the candlestick chart, and we add an indicator, the highest high value with period of 14 trading days, and the lowest low value with a period also of 14 days. So with this indicator, since we are selling a cash secured put, we are more interested on the lowest low value in the last 14 trading days. So as you can see, the lowest low value is $22. So with this indicator, we tend to sell our cash secured put below $22. In our case, we chose at least 2 strike price before $22. So we chose 20, and by this time we already have deposited to our IBKR account $2,000. So we will use this to sell cash secured put. So for now, don't mind yet the highest high value, but later on, maybe in the future, we will touch into this if it is needed. Because this one, if you want to sell a covered call, which is another strategy also, you will use the highest high value. So let's log into our IBKR account. As you can see, there is already $2,000 deposited. So we're gonna search SOXL. The current price at the time of recording is $24.97. So we go to the quote details and go to options. Usually we trade 30 days, minimum 30 days and above. So we chose the August 25. And the strike price we chose is $20. The premium is 60 cents, and usually we choose the midpoint, which is 63. So a midpoint between the ask price and the bid price. Submit to sell. And it's filled. And as you can see, the SOXL is there in our portfolio. And the position is -1. It means you are selling an option. So your position is -1. So if the price of SOXL on August 25 after market close is more than $20, then we are not going to be assigned, and IBKR will refund our $2,000 in cash. But if the price of SOXL after market close on August 25 is less than $20, we will be assigned on the next trading day, and we are obligated to buy 100 shares of SOXL. IBKR will use the money that they put on hold for us to purchase the shares. So the total premium is $62.13 after commission, and the yield for that 1 month is 3.1%, or a hypothetical yield of 37% per annum. By the way, one option contract is 100 shares, so premium of 63 cents times 100 is $63. So that's all for now. I hope this information is useful, and please do your own due diligence if you enter this kind of trading, because it involves high risk. Remember, only invest what you can afford to lose.